Okay, I'm going to start today with a title that I absolutely know, is going to make some of you want to throw your device across the room.
Oh, I'm sure of it.
The headline we're breaking down is Why Selling All Your Bitcoin for Stablecoins Might Actually Be the Smartest Move Right Now.
It sounds like absolute heresy, doesn't it?
It sounds like the worst kind of clickbait. I can practically feel the collective blood pressure rising. I mean, we're talking to active crypto investors here.
Right.
People who've spent the last decade being told that cash is trash, inflation is the enemy, and, Bitcoin is the only lifeboat.
And now we're saying on Sunday, January 25, 2026, that the smart move is to dump the hardest asset on earth for digital fiat.
Exactly.
I know. It triggers that immediate immune response. But that reaction is exactly why we need to do this deep dive, because yes, the title is clickbait, but I'm going to stand by it.
You really are.
I am. If you look at the data, and we've
Yeah.
got a massive stack of it today, the math is painting a very, very different picture than the narrative we're all used to.
So the mission today isn't just to provoke, it's to ask a really uncomfortable question. Is our loyalty to number go up actually costing us money?
That's the question. Because there's a portfolio allocation nobody is really talking about, but the whales are quietly executing it.
Okay, so to understand that, we have to look at the landscape. It's early 2026.
Exactly. Bitcoin and Ethereum are battle-tested. They're the giants. But right now, they're acting as very volatile stores of value. They swing.
Sometimes violently.
Right. Meanwhile, stablecoins have quietly evolved from just being a place to park your cash on an exchange.
Yeah, they used to just be the sidelines. You sat in USDT or USDC while you waited for the dip.
Not the sidelines anymore. It is a $300 billion market. Projections see it hitting, what, $2 trillion by 2028?
Yeah.
But the aha moment isn't the market cap, it's the yield.
And this is the core conflict of this deep dive, right? Most of us, and I'll include myself, are obsessed with asset appreciation. We want the 10x.
That's the blind spot. We treat crypto like a lottery ticket. We're completely ignoring yield. Think about it this way. Bitcoin is phenomenal. It's digital gold. But it is a non-productive asset.
Its native yield is zero.
Zero. If you hold one Bitcoin today, you have one Bitcoin next year. The only way you profit is if someone else pays more for it later on.
Whereas stablecoins have transitioned into what the sources are calling productive assets.
Correct. And we're not talking about, 0.5% in the savings account. We're seeing 6 to 16% APY on centralized platforms and some advanced strategies pushing 20, even 30%.
Okay, we have to pause there. Because when I hear earning 8 to 20%, my PTSD from 2022 kicks in. I think of implosions. I think Ponzi.
And you should. Skepticism is survival in this industry. But the whole premise of this great rotation isn't just buy stablecoins and pray. It's about a specific portfolio model.
The barbell strategy.
The barbell strategy. It's about optimizing for yield, for liquidity, and for what we call a dry powder.
Let's get into that then. Section 1. The case for the great rotation. You mentioned the opportunity cost of holding 100% Bitcoin. Break that down for me.
You're losing what we call the interest rate differential. Let's just look at the hard numbers from the reports. Centralized platforms like Nexo are offering somewhere between, say, 6 and 16% on dollars.
Mm-hmm.
DeFi protocols like Aave and Morpho, maybe 4 to 12%. And then the really complex stuff, Ethena, Pendle, they're pushing 15 to 30%.
That is a massive spread.
It is. And the compounding power is what people just completely underestimate. If you compound a 10% yield over 5 years, do you know what happens to your principal?
It goes up significantly, but give me the number.
You get a 61% increase.
Yeah.
That is a quote-unquote guaranteed return.
Yeah.
Bitcoin has to fight through all its volatility just to beat that.
Right. If Bitcoin just goes flat for 2 years, which it has done before.
The stablecoin holder is up over 20%. The Bitcoin holder is flat. And that's painful.
Flat is excruciating. Okay, so let's talk about the allocation, the barbell strategy. What does this ideal 2026 portfolio actually look like?
The model proposed is a 40-50-10 split.
Okay.
You keep 40% in Bitcoin. That's your store of value, your beta exposure.
Mm-hmm.
10% in altcoins for that high-risk, high-reward alpha. But the heavy lifter, 50% in stablecoins.
Whoa! Half the portfolio. That feels incredibly defensive. Why so high?
It's not just defense. This is the part that usually clicks for people. It's about strategic optionality. It's about dry powder. Do you remember October 10th, 2025?
Vividly. The trade war tantrum. The market just flushed. Everything was red.
Everything. Leverage was wiped out. Now, imagine you were 100% in Bitcoin. You took a huge hit on your net worth instantly. Your purchasing power vanished right when everything was on sale. You were paralyzed.
Oh, I was definitely paralyzed. I was just refreshing the screen, hoping it would stop.
But if you were running the barbell with 50% stablecoins, you weren't paralyzed. You became a liquidity provider. You had cash. You could step in and buy those distressed assets at a massive discount.
So while everyone else is panic selling, you're panic buying.
Precisely. You shift from being a speculator just hoping the price goes up to a capital allocator who profits from other people's panic.
I like that distinction, speculator versus allocator. Let's make this real then. One of our sources ran a simulation for a $100,000 portfolio. Pure Bitcoin versus this 50-50 yield barbell. Walk us through it.
They modeled two scenarios. Scenario A was a raging bull market.
Straight up.
Right. And obviously, in that world, Bitcoin wins. If Bitcoin does a 3x, the stablecoin portfolio lags because half of it is only earning, say, 15%.
That's the FOMO tax. That's what keeps people 100% in.
It is. But look at scenario B. They included a bear market drop around 30%. The 100% Bitcoin portfolio crashes 34%.
Okay.
But the yield barbell portfolio,
How do I do?
it only drops about 15%.
That's huge. You cut your losses by more than half.
And remember, you're still earning yield on that stable 50% the entire time. The portfolio just dampens the volatility. It prevents that wipeout risk.
And in crypto, survival is the name of the game.
If you get wiped out, you can't play the next hand. The barbell ensures you always have chips on the table. It's the sleep at night factor.
But I can hear our audience screaming right now, okay, I get it, but where is this yield coming from? 15% on a dollar-pegged asset sounds like magic. Or a scam.
It's crucial we break this down because it isn't magic, it's just market structure. Our sources break it down into three main buckets. The first is institutional, or CeFi. Platforms like Nexo, Binance.
The centralized players.
Right. The yield there is driven by institutional demand for leverage. Hedge funds need to borrow dollars to trade, and they pay a premium. But the big change in 2026 is the regulatory environment. We have to talk about the Genius Act.
The Genius Act. I swear they work backward from the acronyms.
They definitely do. But despite the silly name, it really changed the game in the U.S. It mandates one-to-one liquid reserves and monthly disclosures. It forced the Wild West of stablecoins to grow up.
So that's bucket one, institutional lending. Now with more guardrails, what's bucket two?
Bucket two is on-chain, DeFi. This is protocols like Aave and Morpho. And this relies on over-collateralized lending.
Explain that for someone who hasn't used Aave in a while.
Okay, think of it like a digital home equity loan. Someone wants to borrow your USDC. To do that, they have to lock up Bitcoin or Ethereum worth more than what they're borrowing.
Like 150% more, usually.
Exactly. If their Bitcoin value drops too low, the protocol automatically sells it, liquidates it, to pay you back. It's all trustless code.
And this is also where real-world assets, RWAs, are popping up.
Yes. This is the big bridge between TradFi and DeFi. You have BlackRock's BUIDL and Ondo Finance bringing U.S. Treasury yields directly on-chain. You can hold a token that represents a basket of U.S. Treasuries earning 4 to 5%.
So my crypto wallet is basically a high-yield savings account backed by the U.S. government, but without the bank.
Pretty much. And then there's the third bucket. This is the most complex, but also the highest yielding, the advanced or synthetic strategies. This is where we see Athena's USDD.
Athena. This one gets a lot of hype and a lot of fear. How does it generate that kind of yield without lending to a hedge fund?
It uses a delta-neutral strategy.
Okay, unpack that. What does delta-neutral actually mean?
Imagine you buy one Ethereum. You're long. If the price goes up, you win. Now imagine you simultaneously short one Ethereum with a futures contract.
So I'm betting it goes up and betting it goes down at the same time.
Exactly, which means your price exposure is neutral. If ETH moons or goes to zero, your dollar value stays the same. You've created a synthetic dollar.
Okay, but if my value stays the same, where's the profit? Why do this?
The funding rate. In crypto, most people are optimistic. They want to be long with leverage. To keep those positions open, they have to pay a fee to the people taking the short side. Athena takes that short side. They are harvesting that fee, the greed of the leveraged traders, and passing it to you.
So as long as the market is bullish and people want to gamble, Athena pays out.
In a nutshell, yes. It turns market speculation into yield for you.
Okay, this is where it gets really interesting and maybe a little scary. We've painted a pretty rosy picture, but there's no free lunch. What are the risks?
There is absolutely no free lunch. If you're earning 15%, you're taking risk. Full stop. The biggest one, depegging.
the nightmare scenario, like Terra Luna.
Exactly. That was an algorithmic failure.
Okay.
But we have more recent examples like USDR Real UST, which collapsed in October 2023. It was backed by real estate.
Which sounds safe on paper.
But real estate is illiquid. That's the key word. You can't sell a house in 5 seconds to pay back a user. When a run on the bank happened, they couldn't cash people out. The peg broke.
Classic liquidity mismatch.
And even with the big players, there are nuanced risks. One source highlighted a specific vote on the AVE protocol about USDD. This one really caught my eye.
I saw that. This was the hard coding issue.
Yes. Token holders voted to hard code the price of USDD to $1 USDT to avoid liquidations.
Wait, explain why that's bad. Don't I want the price to be stable if I'm lending it out?
You want the real price to be stable. You don't want the system to pretend it's stable. Normally, if the collateral drops in value, the system liquidates it to protect you, the lender.
Right.
But if the system is hard-coded to pretend the price is $1, even when it's trading at 65 cents in the real world, which it did, then the liquidation doesn't happen.
So the safety mechanism is just off.
Exactly. The risk shifts entirely to the lender. If the price doesn't recover, you're left holding a bag of undervalued assets. The protocol governance basically voted to increase risk for lenders to protect borrowers.
That is concerning. It shows DeFi isn't just code, it's politics.
It introduces human risk. Then you have looper risk.
Loopers, what are those?
Just leverage spirals. Speculators borrow stablecoins to buy more crypto, then borrow more against that and buy even more. When the market drops, it triggers a cascade of liquidations. This can cause a liquidity crisis where lenders literally can't withdraw their funds.
A run on the bank, but happening at the speed of the blockchain.
Correct. And finally, the Genius Act cuts both ways. Regulation brings safety, but it also brings compliance risk.
Censorship.
Right. Aggressive regulation could mean freezing assets. If a regulator decides a protocol is non-compliant, your safe stablecoins could be frozen. It's that constant tension.
So if I'm listening to this and I'm looking at my portfolio, which is, 90% Bitcoin and 10% Hope, what's the takeaway?
It means the Great Rotation is about maturity. It's about moving from a mindset of holding for dear life to one of allocating for yield.
It feels like growing up, it's less exciting than watching a chart go vertical, I'll admit.
But it's a lot more sustainable. Stablecoins aren't just boring cash anymore. They are the monetary base of the internet age. They offer a way to opt out of volatility while earning institutional-grade returns.
So the final verdict is, maybe it's time to stop looking at the price of Bitcoin every 5 minutes and start looking at the APY of your portfolio.
And ask yourself, am I a speculator or am I a capital allocator? The tools are there now to be the latter.
I want to leave everyone with a provocative thought, something that really struck me from the sources. We always talk about Bitcoin disrupting gold or banks, but think about this. If stablecoins let us access U.S. Treasury yields, lend globally 2047, and protect our wealth without a bank, could it be that stablecoins, not Bitcoin, are the real killer app of blockchain?
It's a massive question. Because if banks lose their entire deposit base to these 10% yielding protocols, why would you keep money in a checking account? What happens to the traditional financial system? That is the trillion-dollar question.
Something to mull over. Thanks for diving deep with us today.
Always a pleasure.
We'll see you on the next one.